The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Programme, and Singapore Polytechnic Enterprise. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. Introduction to Personal Investing. This is the second video in a two-part series. This video will focus on what you need to start your investment journey, understanding the features of some financial products, and how to construct, monitor, and rebalance your investment portfolio. What you need to get started on your investment journey. You will need to open two accounts. The first is a central depository, or CDP account, which acts as the custodian of the securities that you buy and sell. The second is a brokerage account, where you enter buy or sell orders. You can open the CDP account when you sign up with a brokerage. You must apply for Direct Crediting Services, or DCS. This is to link your nominated bank account with your CDP account so you can pay for purchases and receive payment for sales and dividends. Next, you have to choose how you wish to settle your trades. For example, do you want to pay via check, online banking, pay now, or arrange for a standing gyro instruction? Once these formalities are completed, you are ready to start. On the Singapore Exchange or SGX, you can buy and sell shares, bonds, and other products like exchange-traded funds. In the next section, we will take a look at some of these products. Some types of financial products. Here are some financial products. 1. Ordinary shares or equities. 2. Fixed income securities or bonds. 3. Real estate investment trusts or REITs. 4. Investment-linked insurance policies or ILPs. 5. Unit trusts. 6. Exchange-traded funds or ETFs. Ordinary shares or equities are issued by companies to raise capital from investors, and they are mostly traded in lots of 100 units. The advantages are that you have the right to attend and vote at general and extraordinary meetings, you have limited liability, you can receive dividends if the company declares payment, shares are usually a good hedge against inflation, and you get to participate in growth prospects and future earning potential. On the downside, shareholders are ranked behind creditors in the event of liquidation or default. Share prices may go up or down depending on market conditions, and in some cases, it is possible to lose everything. In addition, SGX may suspend trading of a company's shares if it suspects a false market exists for those shares. If you use leverage, the losses will be magnified. It is best not to borrow to invest as it increases your risk and potential losses. When investing in shares, bear in mind the following. Equity investing is considered risky as prices can fluctuate widely. Make sure you construct a sufficiently diversified portfolio to reduce risk. Be prepared to stay invested for the long term to ride out short-term volatility. Be familiar with the companies. Make use of free screening tools on the SGX website. Fixed income securities or bonds are issued by companies or governments. They pay periodic interest based on the coupon rate, usually every 6 months. At maturity, the bondholder receives the face value. Depending on the credit quality of the issuer, cash flow is relatively certain, so bondholders can enjoy a steady stream of income. Unlike share dividends, which depend on management's discretion and may not be paid in some years, non-payment of coupon interest triggers a default event. If this occurs, bondholders are ranked ahead of shareholders if the company is liquidated. Bonds are usually combined with equities in a diversified portfolio. The main risk for bonds is default or credit risk, which occurs when the company or government that issued the bond is unable to pay its obligations. Like stocks, bonds are subject to market and specific risk. Market risk refers to factors that affect the entire market, such as the global financial crisis or the COVID-19 pandemic. Specific risk refers to events that affect only that company or industry. For example, a plunge in oil prices, which would then badly affect the oil and gas sector. Currency risk applies to any product that is denominated in other currencies. Interest rate risk refers to interest rates moving up after the coupon rate has been fixed at the time when the bond was issued. Liquidity risk refers to the fact that there could be less trading in bonds compared to shares, as bondholders typically buy and hold. Investors may not be able to exit quickly at an efficient price. Reinvestment risk refers to the risk that you may not be able to invest the interest income at the same or better return than what the bond is giving you. When selecting fixed income securities or bonds, check the following: credit quality of the issuer and watch for potential events that can erode the issuer's credit strength. Coupon rate and how it compares with the level of interest rates in general. Length of the term to maturity. Other features such as call and put options and convertibility. Callable bonds allow issuers to redeem before maturity. Puttable bonds allow investors to sell the bond back to the issuer before maturity. Convertible bonds allow investors to convert the bonds into shares. A unit trust is a professionally managed fund invested in a portfolio of financial assets. The main advantage of unit trusts is that they provide exposure to markets that may be difficult or expensive for individual investors to access by themselves. Another advantage is investors are able to gain exposure to a diversified mix of securities with a small investment. Unit trusts can also generate income if dividends are paid or if the assets held are bonds. There are many unit trusts, so take time to understand what are their investment strategies, which markets they are invested in, and who are the fund managers before buying. Also find out what are the fees and charges. These are payable regardless of the performance of the unit trust. Unit trusts are not capital guaranteed products. Considerations when selecting unit trusts. Choose funds that meet your investment objectives and risk profile. Monitor performance regularly. Find out about the type and amount of fees payable. If you cancel your purchase within 7 days, there is no penalty. But if the value of the fund has dropped during that period, you have to bear the loss. Investment-linked insurance policies, or ILPs, provide a combination of protection and investment. Premiums paid are used to buy units in a unit trust of your choice. Units are then redeemed to pay for fees, expenses, and insurance charges. The advantage of ILPs is that they offer the flexibility of protection and investment with a small capital outlay. Typically, you can adjust the level of coverage at any time, up to a maximum amount depending on how much premium you are paying, and it is possible to withdraw cash by selling off units in the underlying funds. In addition, unit trusts are professionally managed. The downside is that insurance charges increase with age, similar to the premium for hospitalization plans. As one gets older, it costs more for the same level of coverage and more units need to be redeemed. Unlike other insurance policies, cash values are not guaranteed. Also, like all unit trusts, fees are still charged by the fund regardless of performance. When selecting ILPs, you should consider if protection is your main concern. If that is the case, then perhaps term policies are more suitable since they are the most affordable. For ILPs, the investment risk is borne entirely by you, whereas in other insurance policies, such as endowments and whole life, once bonuses or dividends are declared, they are payable to you. Exchange-traded funds, or ETFs, are pooled investments similar to unit trusts, but differ in that ETFs are listed on a stock exchange, and you can buy or sell them just like shares. Most ETFs mirror the performance of their underlying indices. ETFs are typically cash-based, meaning they buy the securities in the underlying index. An example would be STI ETF, which invests in the same shares as the Straits Times Index. If the index goes up by 10%, the ETF should also rise by 10%. There are also synthetic ETFs, which use derivatives such as swaps, futures, and options to give you the desired exposure. Synthetic ETFs are complex products that generally employ leverage and hence are not suitable for most retail investors. ETFs allow investors to achieve diversification with a small outlay. As they are listed, investors can buy and sell anytime they want, and just like stocks, ETFs can be traded online. Index ETFs allow you to gain exposure to the performance of an index. As they are passively managed, the management fees are lower than actively managed funds. The transaction cost to buy or sell ETF is your brokerage fee, which is also typically lower than transaction costs for unit trusts. The ETF provider may not buy all the assets in the index, so there may be a small difference between the performance of the ETF and the underlying index. This is known as the tracking error. As with most investment products, ETFs are not principal guaranteed, and remember, synthetic ETFs are complex products, so the risks are higher. When selecting ETFs, ensure that investing in any particular ETF fits your risk profile and that it will help you achieve your investment objectives. And ask about transaction charges. REITs are pooled investment funds, just like unit trusts and ETFs. They invest in properties and are listed on the stock exchange, so you can buy or sell them just like shares. REITs allow us to invest in real estate without actually buying the properties directly. You can own a multi-property diversified portfolio without a huge investment that includes retail, office, data center, healthcare, and hospitality assets. REITs are incentivized to distribute at least 90% of their taxable income, so unit holders usually enjoy regular cash flows. Unlike rental income from a physical property, which is subject to personal income tax, distributions by REITs are tax-exempt. On the downside, REITs rely substantially on debt to finance their property acquisitions. During periods of economic weakness and rising interest rates, they may have to reduce or stop their dividend payouts to conserve cash. REITs that are highly dependent on short-term debt have higher refinancing risk compared to those with mainly long-term debt. REITs with too much borrowing may have difficulty in debt refinancing and may even have to sell off some properties. There is also exchange rate risk if a REIT's properties are overseas and rental is in foreign currencies. Considerations when selecting real estate investment trusts or REITs. Read and understand the REIT that you are buying. The type and quality of a REIT's assets are important factors to consider. For example, demand for industrial and office properties tends to be more sensitive to the economic cycle than properties related to healthcare. REITs rely substantially on debt to finance property acquisitions. While leverage can enhance a REIT's distributable income, it can also reduce its distributable income during periods of economic weakness and rising interest rates. REITs that are highly dependent on short-term debt have higher refinancing risk than REITs with mainly long-term debt. This is why REITs are often evaluated based on their gearing. REITs with high gearing may find difficulty in debt refinancing. They may then cut dividends to conserve cash or issue new units. How to construct, monitor, and rebalance your investment portfolio. For your personal profile, take into account your age, financial needs, and amount of funds you have for investment. When setting your investment objectives, consider your financial goals, risk profile, and investment horizon. Are you looking for growth, income, or security, or some combination of these investment objectives? When deciding on your investment strategies, use the 3 covered in this module: diversification, asset allocation, and dollar cost averaging. Within each asset class, choose which industry or product you want to include in your portfolio. Bear in mind the current economic and market outlook, And make sure that you monitor your portfolio and rebalance periodically or when your situation or market conditions change. Who are you dealing with? You are strongly encouraged to deal only with persons regulated by MAS. Ask for his or her unique representative number and check against the MAS Register of Representatives on the MAS website, whether this individual is an appointed representative, regulated activities which the individual is allowed to conduct, the financial institution the individual represents, any suspensions, revocations, and prohibition orders issued against the person by MAS. The financial advisor representative must go through the Know Your Client process with you to understand your needs, explain why the recommended investment products are suitable for you, and explain the features of the products, the cost, and charges involved. Here are the key takeaways. Always be clear about your investment objectives and your ability to withstand risk and losses. Do not put your money into investment products that you do not understand. Allocate your funds according to your investment objectives and risk profile. A diversified portfolio can help you better withstand the fluctuations of economic and market conditions and cycles. Regularly review your investment portfolio.